Somewhere in the desert right now, a company is quietly buying up hundreds of acres of empty land. No houses going up, no stores, just land, and a promise from the local power company that electricity is coming. That's it. That's the entire pitch. And somehow, that empty dirt is worth more than most office towers in a major city. Welcome to the most expensive real estate you'll never see advertised. And by the end of this video, you'll understand exactly why. Okay, so you want to own a data center. You picture rows of blinking servers, racks humming quietly in a temperature-controlled room, and a fat monthly check rolling in from tech companies who need somewhere to store the entire internet. Every headline about AI right now mentions data centers. Money is pouring in. Land is being bought by the acre. It feels like the closest thing to owning a toll booth on the information superhighway. Sounds simple. It is not simple. By the end of this video, you'll understand exactly how data center ownership actually works, what it really costs to get in, how the money actually flows, and why some of the smartest investors in the world are pouring billions into these buildings, while others have gotten burned badly enough to walk away entirely. Let's start with what it actually takes to get in the door. A small co-location facility, the kind that leases rack space to local businesses, can start around $2 million to $5 million for a modest build-out. A mid-size wholesale data center, the kind that leases entire suites to enterprise clients, typically runs $20 million to $50 million. And the hyperscale facilities you hear about, the ones built for companies like Amazon, Microsoft, or Google, those routinely cross $500 million to over $1 billion, depending on power capacity and size. Here's the trap that catches new buyers off guard. The building is the cheap part. Power is the expensive part. A data center isn't really a real estate asset. It's an energy asset wearing a real estate costume. Getting enough electrical capacity delivered to a site, sometimes 50, 100, or 200 megawatts, can take 2 to 5 years of utility negotiations, grid upgrades, and substation construction. And that timeline doesn't move just because you have the money. Buyers who skip this step and buy shovel-ready land without confirming actual power delivery timelines often sit on dead capital for years. Buying an existing, already leased data center versus building one from scratch tells a very different cost story. Buying an operational facility with tenants already in place might cost you a premium, sometimes 20 to 40% over replacement cost, but you skip the multi-year construction and power provisioning nightmare and start collecting rent almost immediately. Building from scratch is cheaper per square foot on paper, but you're absorbing years of zero income while carrying construction loans, land costs, and power infrastructure fees that can balloon 15 to 30% over initial estimates. Cheap land is cheap for a reason, usually because the power isn't there yet, or the fiber connectivity is thin, and fixing either one costs more than the discount saved on the dirt. Now, here's how a data center actually makes money, and it's layered in a way most people don't expect. Layer 1 is base rent, charged per kilowatt of reserved power capacity rather than per square foot, typically in the range of $100 to $200 per kilowatt per month for wholesale space. Here's the counterintuitive part. The physical footprint barely matters. A tenant could lease a tiny room, but if they need 5 megawatts of power running through it, that's what determines the bill. Think of it less like renting an apartment and more like renting a fire hose. You're not paying for the pipe, you're paying for how much can flow through it. Layer 2 is power pass-through and markup. Operators buy electricity in bulk and resell it to tenants, often with a modest markup of 3 to 8%. It sounds small, but on a facility drawing tens of megawatts around the clock, that markup alone can generate millions annually. Layer 3 is connectivity and cross-connect fees, charging tenants to physically link their servers to other tenants' networks or to internet exchange points, often $300 to $1,000 per connection per month. Here's where it gets interesting. This tiny line item, almost an afterthought on the pitch deck, can carry profit margins north of 80% because the actual cost of a cable is nearly nothing compared to what's charged for the network access it enables. Layer 4 is managed services, remote hands, installation labor, security monitoring, billed at $75 to $150 an hour or bundled into premium contracts. This is where operators pad margins on tenants who don't want to send their own staff on site. Layer 5, and this one surprises people, the biggest tenants often pay the least per kilowatt. Hyperscale clients signing 10 to 15-year leases for 50 plus megawatts negotiate steep volume discounts, sometimes 20 to 30% below market rate. Read that again. The company with the deepest pockets pays the smallest unit price because their long-term lease de-risks the entire facility for the lender who financed it in the first place. Stability, not size, is what gets rewarded. Layer 6 is the exit itself. Data centers with stable, long-term leases in place routinely trade at capitalization rates of 5 to 7%, among the tightest, most desirable rates in commercial real estate, meaning the asset itself can appreciate substantially just from being fully leased to credit-worthy tenants. But here's what doesn't show up in the glossy pitch deck. First, cooling costs. Servers generate enormous heat, and cooling can eat up 30 to 40% of total facility operating costs. As rack density increases with AI workloads, older facilities built for lower power density often can't retrofit cooling systems cheaply, forcing expensive mid-life overhauls. Second, uptime penalties. Most data center contracts include service-level agreements guaranteeing 99.9% or higher uptime. Miss it? Even for an hour of unplanned downtime, operators can owe tenants credits worth 5% to 100% of that month's fees, depending on severity. A single major outage has wiped out an entire quarter of profit margin for smaller operators. Third, and this is the domino effect, a power failure doesn't just cost you the SLA penalty, it can trigger tenant contract cancellation rights, which triggers vacancy, which triggers the facility falling out of compliance with the debt covenants lenders required based on projected occupancy, which triggers refinancing at a worse rate. One bad night with a backup generator can cascade into a multi-year financial headache. Fourth, staffing. These facilities require 24/7 specialized technical staff, electrical engineers, cooling specialists, security personnel, and in competitive markets, that talent commands salaries 20 to 40% above general facilities management pay, with high turnover adding recruiting costs most first-time owners never budget for. Let's look at a case study that captures this whole arc. Picture a mid-sized data center operator who broke ground in a booming secondary market around 2016, riding the early wave of cloud migration. For the first 5 years, business was strong. Anchor tenants signed long leases, occupancy hit 85%, and the facility refinanced at a great rate, allowing the owners to expand a second building on the same campus. Then came the turning point. A regional utility, overwhelmed by new data center demand in the area, delayed a planned substation upgrade by 3 years, capping the facility's available power right as a major tenant needed to expand for a new AI workload. That tenant left for a competitor with available capacity. Vacancy rose, debt covenants tightened, and what was once the star asset in the portfolio became the one dragging down the balance sheet, eventually selling at a discount to a buyer willing to wait out the power upgrade. The takeaway is blunt. You're not really in the real estate business or even the technology business. You're in the electricity supply chain, and if you don't control your power, you don't control your future. So let's talk numbers. Good year versus bad year. In a good year, a well-leased mid-sized facility running near full occupancy with long-term hyperscale or enterprise tenants might generate net operating income in the range of $8 million to $15 million on a $50 million facility, a healthy 15 to 25% return before accounting for major capital expenditures. In a bad year, a major tenant churn, a power delay, an unexpected cooling system failure, that same facility could see net operating income collapse to $1 million to $3 million, or even go negative once emergency capital repairs and SLA penalties are factored in. The gap isn't small. It's the difference between a trophy asset and a distressed one, and it often hinges on just 1 or 2 contract renewals going the wrong way. What separates the operators who survive the bad years from the ones who don't usually comes down to diversification of tenant base and conservative leverage. Owners who avoided over-concentrating on a single anchor tenant and who didn't max out debt assuming best-case occupancy forever tend to absorb a bad year as a rough patch. Owners who bet everything on one hyperscale lease and financed aggressively against it often don't get a second chance. So why do sophisticated investors keep piling into this space despite all of this? Here's the insider secret. Data centers offer a rare combination most asset classes can't match: long-duration, investment-grade tenant leases similar to a bond, combined with real estate depreciation benefits and exposure to what may be the biggest infrastructure build-out of the decade.